Hello everyone, Ryan Alice here. Welcome back to the SaaS growth course. Today, we're going to be talking about revenue-based financing, how to use non-dilutive sources of capital to scale up a SaaS firm. Let's jump in here. All right, so in this lesson, we're going to share how to access non-dilutive growth capital for your firm using RBF, revenue-based financing, and some other types of SaaS debt in order to grow without giving up equity using platforms like FounderPath. Now, this is an area of capital that wasn't available when I was building iContact. It was either complete bootstrapping or complete venture capital. There was nothing in the middle unless you were profitable. And of course, most growing SaaS companies are not yet profitable until many, many years. Now, once you're profitable, you can go get a loan from a bank. But until then, you need either equity capital or revenue-based financing to scale. And so what we're going to talk about today is how to do revenue-based financing and other forms of non-dilutive capital so you don't have to give up your equity in order to grow. I'm also going to be talking about FounderPath. There's a link to FounderPath here that is specially created for the SaasRise community. Check that out. You'll get good pricing on any non-dilutive capital that you want to do. Oftentimes FounderPath can do, depending on your SaaS credit score, which I'll talk about, anywhere from, let's call it 16% to 20% annual interest, and sometimes even lower for the bigger deals. So it's important to underline what we talked about in the last lesson. Do not raise external institutional venture capital until you've built a growth engine, a proven multi-channel growth engine. And then once you've built that multi-channel growth engine, which might take a year, 2, 3 years, and ensuring that it works without you, so that you have a real system and a real business rather than just a job, then you can consider raising outside capital. But you might not even need outside equity capital, because now you can take non-dilutive growth capital that is paid back from your future revenues, a percentage of your future revenues. So let's jump in. Let's talk about revenue-based financing. So RBF allows SaaS firms to get the capital they need to invest in sales, marketing, and R&D. Revenue-based financing firms usually have formulas for how much they'll lend you based on a percentage of your current ARR. So if you have 2 million in current ARR, they'll probably lend you up to 1 million. Now, you don't want to take too much because then your revenue gets docked every month to pay it back for 2-3 years. But taking some amount, 10%, 20% of your top line revenue in order to reinvest it, not in founder liquidity, but in sales and marketing or R&D that will allow you to scale customer acquisition. Now that is smart, and that is what can allow you to grow very quickly without requiring outside venture. So what are the 6 types of non-dilutive SaaS capital that we're going to talk about today? We're going to talk about revenue-based financing, term loans, interest-only loans, credit lines, asset-backed loans, and venture debt, which usually is debt that comes along with equity financing. And I'm going to spend most of the time talking about revenue-based financing because I think it is the most innovative, novel, and useful for companies, SaaS companies in the 500,000 to say 15 million range, where you want to scale up and reinvest in a proven growth engine. So brief overview of the 6 types of debt. Revenue-based financing, it's where firms like FounderPath give you money up front based on a multiple of your MRR, usually up to 6 times your MRR, half times your ARR, and then you pay them back every time, usually on the last day of each month as a percentage of revenue. This can be sometimes done as invoice factoring and sometimes as a cash advance, but it's effectively a loan that you pay back with interest, usually anywhere from 12, 14% at the very low end up to maybe 20% at the high end, depending on the actual fundamentals of your business. They connect to your Stripe, they connect to your Chargebee, your billing system, to your QuickBooks even, and then they'll provide an assessment of your interest rate based on the actual risk. The second is traditional term installment loans. These can come from banks. These are generally available only if you have assets like real collateral, like land, real estate, or significant EBITDA, significant net profits. That's why we're not covering that too much here. You can do interest-only loans from firms like Timia, RiverSaaS, Espresso, and Coho Growth Capital. These are often 2 to 3 year interest-only loans. They tend to be available once you're bigger, 2, 3, 4, 5 million in ARR and up. But they do start out as interest only for the first 1 to 3 years, which can be very, very helpful. And then you can always, as long as you're still growing, refinance them with someone else to get an additional interest only loan and just extend the principal payback. You can also get a credit line. This is a loan with interest that can be drawn down as needed and paid back as needed without prepayment penalties, paying for only what you use. You can get asset-backed loans secured by real estate, equipment, or hardware. These usually have lower interest rates, but there's a big penalty if you don't pay it back in that you lose the asset. And then there's also venture debt. This is a loan after an equity investment from a VC firm, usually with warrants that allow the lender to purchase equity in the case that your company succeeds. This is only available to venture-backed companies. The big players here are WTI, Montage Boathouse, and SaaS Capital. You do get debt at maybe like 7 to 9% interest, but maybe 10, but you're going to get, really, they're going to get their money back because they're going to get 1, 2, 3, 4, even 5% of the company in warrants at a low strike price. All right, so what are the important terms as you're thinking through this? Term length, think through that. Paying back over a year versus 3 years is a big difference. Paying back principal in 6 months versus paying back principal after 3 years, big difference. You want to look at the interest rate, and sometimes firms will show a discount rate, which is not the same thing as an interest rate. You get the rule of thumb there is just double the discount rate to equate to the approximate interest rate. You can use this calculator to convert every offer to an effective annual interest rate. Can the loan be interest only? In other words, deferral of principal. Do you have to give out warrants or options with the debt? And then what does the debt restrict you as a company from doing? Maybe you couldn't take on additional debt until you paid it back. Maybe you couldn't sell the company or acquire another company or do founder liquidity. Look at the covenants very closely. Look at any restrictions on use of proceeds. Some firms limit capital usage to just sales and marketing. Some firms limit capital usage to just sales and marketing or R&D, but take a close look at that. And usually you won't have to do a personal guarantee, although if you do want to offer one, I wouldn't recommend it. But if you do want to offer one, it can certainly reduce the interest rate quite a bit. And then, what happens if you pay off early? Are there prepayment penalties? Do you have to pay the interest for the entire term? Can you refinance it? These are all the questions that you want to ask. Here are some of the major players in SaaS debt. We're going to focus in a minute on the top left quadrant, revenue-based financing providers. But you can also go to these venture debt providers once you have venture capital from an institutional partner, or you could go to the bank loan providers that work with SaaS players that are bigger, once you're at 2, 3, 4 million in ARR and up, or the non-bank term loan providers that you see here on the screen. So I'm going to focus in on these revenue-based financing providers. I've known the founder of FounderPath for about 13 years, a guy named Nathan Lack. I've spoken at his conference, SaaS Open, here in Austin, Texas. And I find FounderPath to be a great company. They've lent out over 150 million now to SaaS companies over the last 5 years, and more every year. And this is all revenue-based financing, where they essentially take a stake in your future revenue and you pay it back over time. FounderPath is really cool. I'm going to show you their interface, and you can sign up for a free account. Use the SaasRise link from the beginning of this lesson, and you can get your own SaaS credit score. So let's take a look at this. So this is our actual FounderPath account. You can say here that we actually took a loan back in, when was it? May of 2024. We took let's take a look at it. We took a $178,000 loan in order to invest in customer acquisition through positive unit economics, sales and marketing. In other words, Facebook ads, Google ads, LinkedIn ads, a salesperson, etc. And then in order to service this loan over time, over 24 months, we'll have to pay back $203,000. And that works out to be $8,400 a month, which is automatically debited from our account at the end of every month. You can see we've made 3 of these payments so far, getting ready to make the 4th. And if we wanted to, though, we could go in and request more capital. Now, I don't necessarily want to do that because then we'd have to pay back $45,000 a month, but we would get $917,000 up front, and we can be approved for up to 50%, roughly 40 to 50% of our ARR. So we can get approved since our ARR is now, just for SaasRise, let's see, the MRR is 178K as of today. So that means the ARR is 2.1 million. So 2.14 million. So times 0.5, that means that half of our ARR is 1.05 or 1.07 million. And so if we wanted to go in here, you can see we can get up to 1.07 million. We've already taken 170,000, so 152,000 is left to pay back. So that means we could take another 917,000 if we wanted to really ramp up our growth. Now, I'm not going to take that much capital yet because we don't need it. You never want to take capital until you need it, and until you have a proven growth engine to put it into, which we're certainly building here at SaasRise now. You can see here the annual discount rate is 8%, which means, as I mentioned, about 16% interest rate. And let's take a look now at some of our analytics. FounderPath is invested in providing really good analytics. You can see here at SaasRise, we have 203 paying customers as of the end of last month. We've got a 606 credit score. It's been steadily going upward each month. And an average revenue per account, we call it ARPA, they call it ARPU, around $878 now. And that the lifetime value is estimated about $16,000 for our customers based on our logo churn. And so go through here, connect to your own Stripe or your own billing system. It'll output your summary statistics, and you'll end up being able to understand your business in a free way. This is similar to the ProfitWell tool, which is a free way to see your own SaaS metrics and compare them and benchmark them against other companies. And then you'll also be able to see what you're eligible for. Now, if you go in and take a loan of less than $500,000, you can get approved in less than 4 days. On the SaasRise blog, which is at saasrise.beehive.com, there is a case study on revenue-based financing, and I'll pull it up for you. Using revenue-based financing to scale up customer acquisition. And this is the exact story of how we took that $170,000 revenue-based financing loan to invest in sales and marketing. What were some of our metrics that we were looking at? What was the process? And you can see here, the process was a 4-day timeline, application, diligence, approval, and wire, all in 96 hours. We took that between April 29th. We applied on April 29th, 2024. We got approved on May 1st, 2 days later, and then we got the wire the next day. So very quickly here, if today's Friday, literally by next Wednesday or Thursday, you could have money sitting in your account, as long as you have an incorporated firm, you've got your metrics ready to go, and you've got significant real revenue. I think their minimum is at least 50K in ARR, but as long as you have more than 50K in ARR, you can get a loan for up to half, 50% of your ARR, really in many countries, not just the US, Europe, many parts around the world, in less than a week. Now, if you're going to take a bigger loan, 750K, $1 million and up, it might be a 3, 4, 5 week process. They do a much more significantly more diligence for those larger loans. All right, so here we go. Let's see here. Should you take an RBF loan to scale up customer acquisition? Well, do you have at least 50K in ARR? If so, yes. Do you know your LTV to CAC ratio? If so, yes. Is it higher than 6-to-1 or more? Yes. All right. Well, then take on that capital to scale up investment in sales and marketing. That is what we recommend here at SaasRise. And overall, this has been a wonderful methodology for us to scale our customer acquisition. And I encourage you to check it out. Let's see here. So there's just a little sheet here. You can check out our full list of non-dilutive SaaS growth capital providers. I'll pull that up. We link to this in the course notes. We have some information on sort of interest rate, payback time frame, and you can reach out to these companies, let them know that SaasRise sent you. And then in the next section, we're going to be talking about raising angel capital. So revenue-based financing can be a great way to scale up investments in R&D and sales and marketing in a non-dilutive way, but you do have to pay it back. And so you'll want to weigh the pros and cons of that. Thankfully, you get to pay it back out of future revenue, but still you have to pay it back. And sometimes raising angel capital can be better. You might give up more of the company, but you might end up being able to grow the company faster with the right people behind you. And so one of the benefits of either angel capital from the right angels, strategic advisors, experienced entrepreneurs, etc., or the right institutional partners, which we'll talk about in lesson 18, is that sometimes you can get some experience to support you and some additional mentors and connections, particularly on the exiting side. We'll talk more about that in the next lesson. Let me know if you have any questions. I'm available to all of our SaasRise members. One of the benefits of being a member of SaasRise is you get free access to me on WhatsApp, on Slack, on email. Reach out, let me know how I can support you. I also do consulting for SaaS companies that are between 5 million and 150 million in ARR to help prepare for fundraisers and exits. Let me know if I can support. Lots of love from Austin, Texas. Hope you're having a great day wherever you are in the world.